Good afternoon, everyone. Thank you for your patience. I welcome to this webinar. Can you hear me properly? I
Yes.
guess yes. Thank you. Good afternoon for those who are joining in. Good afternoon. Thank you for your patience again, and welcome to this webinar on collective impact through collaborative engagement. It will be led by Michael Mango shortly. This meeting is recorded, so please keep in mind to mute your microphone or keep it on mute. And I leave the floor to Michael.
Yes. Thanks, Laetitia. Nicolas, do you want to show the slides? I can give, to start with, I'm going to explain what it is about. So last week, we already had one webinar that was on one particular impact mechanism that was price signaling. And this one is a follow-up. And it will deal with a very different impact mechanism, which is engagement. So the results are derived from a technical paper that deals with those two impact mechanisms. But here we're going to focus only on one of them, which is collaborative engagement. The two impact mechanisms were chosen because we consider them to be the only ones that can function in secondary markets. And but we have a very strong, we do favor at 2DI, we really do favor engagement compared to price signaling. In the webinar last week, the conclusion, the most important conclusion was that under most circumstances, price signaling couldn't work. So the only impact mechanism that is left available for investors in secondary markets will be de facto engagement. And engagement can be done with much more effectiveness if done collectively. That's why we're going to study this mechanism today. So Nicolas, yes, we can move on a bit.
Maybe also for any questions, etc. We decided that I think it's best that you raise them first in the chat, and then maybe Laetitia, when you see them, because I don't see them now that I present, you can just intervene, and then we address them.
Sure.
But probably later we can also just engage in a direct dialogue. But for now, then let's just start. Please.
Yeah.
Michael.
So thanks, Nicolas. So as I said, the results are, yes, we do have the recording, Peter. So yeah, I don't know how we're going to disclose it, but is it on the website, Laetitia, or?
It will be on the website, and I will send it to the participants.
Okay, good. Thanks so much. So today, no more discussion about price signaling. So let's focus only on engagement. So if you want to know more about the topic, so you can have access to the briefing on engagement, which is one short paper, and the very extensive paper is the technical report. So both are available on the website as well. So okay, Nicolas, next slide, please. So why are we discussing collaborative engagements? Because as I said before, it is supposed to be a major, or even more, the most important impact mechanism available in secondary markets. Because in primary markets, we have other impact mechanisms, but in secondary markets, the list is much shorter. The problem is that engagement is doomed by a free rider issue, at least if ownership of companies is vastly dispersed. But in the last 40 years, we observed a few tectonic shifts in the way companies are owned, and those shifts could have made a stronger case in favor of engagement. I'm going to discuss the different tectonic shifts, but we have seen a reversal in the view on engagement in the last decades because of such a change in ownership, as if engagement would be much more effective now than it used to be because of, and I can say it, because of larger institutional investors owning all the markets. So we shifted from a very negative tone on engagement to a much more positive. And this narrative, it's a narrative of systematic stewardship. This narrative is can be discussed now, and we already have observations about how the very large institutional investors behave, and do they behave as systematic stewards? That's the question to ask. And we do have data to solve the issue. And you're going to see that, no, they are failing pretty short compared to the very positive expectations about their engagement behavior. So perhaps the solution is not to rely on very large institutional investors doing all the job. Perhaps the engagement has to be carried by coalitions of investors that gonna split the cost of it, and that gonna be more effective because they're gonna access to a larger critical size. So we're gonna investigate this. Yeah, Nicola, next slide, please. So first, engagement is having a pretty strong case. We have a lot of empirical studies showing that ESG requests tend to have a pretty decent success. So depending on the studies, so depending on the period and the zone, the geographic zone, the success rate is between 2/5 and 6/5 and between 20 and 60%, let's say. So it's a pretty decent success rate. But the success rate will be dependent on a series of factors, and especially the cost of reform for the companies. There are some requests that do not require a very strong upheaval of the company processes, while some others are much more solid. So the success rate will depend on the type of request and the type of reforms that is asked for. But keep in mind that the few empirical studies working on the success rate of ESG engagement campaigns conclude that they tend to achieve their goals with a pretty decent rate. Okay, next slide, Nicola, please. So as I said before, we started with very negative tone. The academia on engagement was very perplexed. Like, what's the point of engaging with companies if you have to carry all the costs and the benefits will be shared to all shareholders if your engagement is a success and the success is reflected into an increase in stock price? What's the point? So we have a typical free rider issue, and everybody tends to rely on other investors to do the job. So there was a very strong rationale for no engagement by investors, which is called a rational apathy of shareholders, whether they are small block holders or even mid-sized block holders. For large block holders, it may be different. Next one, please. But in the last decades, as I said before, there have been a series of tectonic shifts. First, more and more of capitals of the ownership of listed companies is owned by institutionals. Second, within the institutional, you have the asset management industry that is getting more and more concentrated with the so-called Big Four. So the four large asset managers from the US, BlackRock, Vanguard, State Street, and Fidelity, that own between 10 and 20% of all the listed companies, depending on the zones. And final shift, the asset management industry has largely moved from active to passive. And being passive means you have to hold your securities. So if you are non-satisfied with the behavior of a company, you can't exit the company. So you have to continue holding the company. And because of that, you may be more interested into changing the company from the inside. So that contributes to, on paper at least, to increase your stake in becoming an involved and engaged shareholder. So some scholars come to the conclusion that some institutions have become too big to be passive, which means they have some features that make pretty sensible for them to be highly engaged with their invested companies, because they are, for different reasons. First, they have a universal ownership, so they own all the markets, basically. So they are not overexposed to one single sector or only a few companies. They own all the markets. So they should care more about systemic issues, because systemic issues will affect the valuation of all the market, and so the valuation of their universal portfolio. A subset of institutional investors, like pension funds, they have very long-term interests. So because of that, they may be interested in systemic issues that will pay off in the long run, like climate change, for instance. And if some asset managers are becoming super big, the cost of engagement that are pretty substantial, the cost of engagement will be diluted over the massive AUM they have. And as a consequence, the cost of engagement can become bearable for them, which was not the case for very small block holders, for which the cost may be prohibitive. So the whole narrative is changing. So for some scholars, it makes total sense for large institutional investors to adopt a portfolio primacy when they engage companies, which means they have to engage companies not considering the effects of on the value of each invested company, but on the value of the overall portfolio. That is the portfolio primacy. That is to be opposed to the shareholder primacy. And they have to run a systematic stewardship instead of a specific stewardship. So that is the new narrative in town. Next slide, Nicolas, please. So does the narrative hold? When we look at empirical data, do they confirm that very much more positive narrative? So if we look, for instance, at the way large institutional investors do vote, we observed an increase in the backing of environmental and social shareholder resolutions, at least until 2021. After that year, we started to observe a reversal, especially for US asset managers. So their tendency to support environmental and social resolutions started to decline. And it declined in 2022, 2023, and I should look at the figures for 2024 for the AGM season of 2024, and I guess the momentum is still negative. When we look at the behavior of asset managers, we see a massive discrepancy between the US asset managers and the European asset managers. So there is a huge gap in the way they support environmental and social resolutions. There is also a gap between the stewardship of passive investors versus the one of active investors. We tend to see a lower support by passive investors. And finally, among the passive investors, we have a subset of them, the big four, so the biggest ones, that tend to be more pro-management and less in favor of shareholder resolutions compared to other passive investors. Next one, please. And look at the data compiled by ShareAction, by the NGO ShareAction. You can see that across years, the percentage of environmental and social shareholder resolutions that were backed by large asset managers tended to constantly increase in Europe, achieving a very high fraction, like close to 90%, while in the US, the proportions of resolution that is supported by large asset managers was starting from a lower base and was even decreasing up to a very small level of support, less than 1/3. So we see a massive gap between the two sides of the Atlantic. Next one, Nicolas. So does it mean that there was something wrong with the rationale? So the rationale was based on the idea that it was relevant for large asset managers to carry systematic stewardship. But perhaps there was a few details in the narrative that were not backed just by evidence. First, it was based on a series of assumptions that the stewardship activity would lead to real-life change in corporate behavior, that the change in corporate behavior will be perceived positively by the markets, and so will lead to an appreciation of a market value, not only for those companies, but for the whole market. And if it turns to creating a negative effect on the stock price of the engaged companies, it should be offset by positive effects for the rest of the market, so that the associated gains for the investor would be positive, and as a consequence, the positive effect on management fees for the asset manager will also be positive. So those are the different bases of the narrative. But if we look carefully at those assumptions, some are lacking solidity. The second one especially. So far, we have no evidence showing that when a company is engaged to change its, let's say, its carbon behavior, its environmental behavior, that the effect is perceived by the market and will be reflected in the valuation of all companies. Let's say a shift in the behavior of an oil major. We have no evidence that it will lead to a reappreciation of the stock prices for all the other stocks because of a positive news for the climate. We don't have such evaluations, but we do have observation of what is the effect on the stock price of the engaged company. And it's pretty counterintuitive, but most of the time it's pretty positive. But again, as I said before, it all depends on the reform type that is required by the engager. And we have some empirical studies that tend to create some simulations to see what could happen to the value of the portfolio owned by the Big Four in case of a successful engagement. And the conclusions are very unclear. It's not sure at all that the Big Four always gain when their environmental or social engagement is successful. It strongly depends on the type of funds they manage. And if they tend to have some very strong thematic funds that are overexposed to brown companies, let's say an oil fund, an oil ETF, they will have an incentive to do nothing, actually, to be very pro-management. And the simulations I looked at were very clear for some ETF managers like Vanguard, because Vanguard is having a very large oil fund. So for Vanguard, it could be even the opposite. The incentive is to continue with business as usual practice, which means pro-management practice. And finally, at the end of the day, if the engagement is successful in raising the stock prices for the whole market, the ETF providers will get only a very small fraction of it based on their very small management fees. So at the end, it could be only a trivial outcome for them, especially when compared to the cost of engagement. So the whole narrative is a bit lame. It's too theoretical. If we look at empirical data or features, it's not a crystal clear pathway for those asset managers to run a systematic stewardship. Next one, Nicolas, please. And if we go one step further, are there really universal honors? it seems so, because as I said before, they own, the big four, I mean, they own like between 10 and 20% of all listed companies, at least in major markets. So it seems that they can credibly be called universal asset owners. But when we think of it, it doesn't mean that they will carry all the cost in case of a systematic negative impact, let's say climate change. For instance, for climate change, most of carbon emissions are not in the hands of listed companies. They are in the hands of state-owned enterprises. So on the one hand, the companies cannot affect the strongest emitters. And on the other hand, they will not stand all the costs of all the negative costs associated to climate change. Because as I said, they are invested in listed companies only. And most of the negative effects of climate change will, not most, but I don't know the fraction, but a significant fraction of it will not be borne by the largest listed companies. They will be suffered by individuals, small corporations, private corporations, states, etc., in which you cannot engage as easily. So they are not universal in their capability to confront the problem, and they are not universal in the cost they're going to suffer. So at the end, that creates some loopholes in the narrative. The cost-benefit analysis is not as clear as it was supposed to be. Plus, as I said before, they may have some very particular thematic funds. And because of that, they may suffer, I mean the asset managers, they may suffer fiduciary conflicts. At overall portfolio level, they may be interested into fighting systematic risks like climate change, but at fund level, they may be strongly interested otherwise, especially if they own, let's say, an oil fund or an automobile fund or whatever industrial fund. So depending on the lens, their interest in doing a systematic stewardship or a shareholder specific stewardship may be very different. Plus, all the business of those asset managers are not only about maximizing management fees. They have other ranges of businesses, like they run state or company pension funds. And because of that, they have to maintain good relationship with local policymakers and the CEOs of listed companies. So the utility function of those very large asset managers is not clearly about maximizing the value of the entire stock market. That could be a strong reason for doing systematic stewardship. No, they may have other interests, side interests, that can be very significant. And if the asset management is only an arm of a universal bank, the interest of the asset management arm may be in conflict with the interest of the CIB department of the bank. So the overall is not sure that it works for the side of systematic stewardship. And finally, you still have, even if you're big, super big, you still have the free rider problem. If you are Vanguard, you still want Fidelity to do all the job. Because again, you're going to have the full cost and you're going to only obtain a very small subset of the benefits in case of successful engagement request and a positive effect on stock prices. So you tend to prefer stay apathetic. Okay, next one, Nicolas. So it's like having super big institutional investors is not the silver bullet. So perhaps it's better not to count too much on them and count more on investor coalitions. Because in an investor coalition, you're going to split the costs And you also split the risk. Because as I said before, you need to maintain good relationship with, let's say, the CEOs in case you want to manage the pension fund of the listed company. But if all the large asset managers are within a coalition, they will split the risk as well, because they will I would say they would degrade the relationship with the listed company the same way for all asset managers. So there is no incentive to stay in the back. Second, it for sure it also increases the effectiveness of engagement, because you gain a critical size. You get closer to the 50% that you need to adopt some votes. So it's good for increasing your chances of success, and also to decrease your individual costs and risk. So the narrative is even better than for large investors. And for companies, it can be also good because it will also decrease engagement fatigue. Engagement fatigue is when you are fed up with discussing with very different stakeholders with very different requests. So if stakeholders form a coalition and ask for the same request, it's a gain of time for the listed companies. So we can see some pros for companies as well. And on top of that, we have a series of empirical studies starting in the early years 2000 that tend to prove that engagement by coalitions is more effective than solo engagements. So engagement performed by individual institutions. So we have plenty of studies on this that is pretty well supported, that it's better to advance like a wolf pack compared to engaging alone. But still, some problems do remain. The coordination does not come without cost. It requires cooperation among different institutions, and sometimes they are competitors. So cooperation among competitors may be difficult to reach. And it will especially work for only a subset of companies, the one with no strong blockholder, like no majority blockholder. And if we look carefully of the ownership of listed companies nowadays, you still see that you have many of them that have majority blockholders or minority but very large blockholders that could come in your way of a successful engagement. So even large coalition may be too small to obtain the majority, I would say, because of that. Next one, Nicolas. But still, it sounds like it's the best option we have. And to make it concrete, investors now have access to a series of tools to coordinate their actions. They can be part of coalitions like CA100+. They can use collaboration platform that the one from PRI, or they can try to coordinate through the action of NGOs like ShareAction, or through investor forums, national investor forums, like you have in France, in the UK, in Italy, in Netherlands. So that could help to unify the engagement request. When we look carefully at the way the coalitions are built, it's like they fall short of the gold standard of coalition. So in another topics, you had some scholars like the Nobel Prize winner Elisabeth Holmström that worked a lot on how the management of commons can be achieved by coalitions. And they derived a list of recommendations for coalitions. And so we can compare the existing investor coalitions with those requirements. And such a work has been done by some researchers. I provided a reference here on that slide. And looking at the way the investor coalitions are commonly structured, they conclude that there are some loopholes in the way the coalitions are built, especially the sanctions are too limited. So if you do some free riding behavior within the coalition, you may not be sanctioned. And for CA100 plus, so far there has been only one removal out of the coalition, only one. It's a passive fund manager from the US, Mellon Investments. And second, what is key is a proportional allocation of cost and benefits. And so far, there is no scheme within coalition that ensure that the asset managers that will be the most committed to engagement, like that would function as lead engagers, that they will enjoy bigger benefits, larger benefits. There is no scheme to ensure this. So still, you have a kind of incentive to stay in the back. So even if coalitions are most probably a pathway for effective engagement, they need to be reformed so that it will emphasize good behavior within the coalitions. And another setback is the fact that if there is an effective coalition, you may have an interest in staying out of the coalition so that all the job will be done by the coalition members, especially if there is no clear reward of being a very active engager within the coalition. So we really have a problem of assigning good rewards for good engagers. And so far, even if there are some papers showing that that can be good for the brand image of asset managers to perform very active environmental and social engagement. The quantification of it is still lacking, and probably the interest is not sufficient to be full skin in the game, I would say. Next one, Nicolas, please. The problem with coalition, with the free rider issue within the coalition, you have it here, or even it could also be considered as greenwashing. You're part of the CA100 plus, and the way you vote is in full conflict with the objective of the coalition. So here you see the voting behavior of large asset managers for flagged resolutions. A flagged resolution is a resolution that is considered to be critical by CA100 plus, and for which the coalition is strongly recommended to vote in favor. So you could expect that all of the coalition members would vote in favor of such a flagged resolution by the coalition. But no, not at all. You have some of them that tend to actually very commonly vote against the resolution, as you can see with the red bars. So you see that BlackRock, for the 20 flagged resolutions, BlackRock voted against them in 18 cases, in 18 occurrences. So in 90% of them, BlackRock voted against, while being a member of CA100 plus. Same for in the same zone for State Street, for Goldman Sachs, for AllianceBernstein, etc. So there is no strict rule to ensure that there will be a voting behavior in accordance to the spirit of the coalition and to the flags of the coalition. Next one, Nicolas, please. So coalitions could be a good way to coordinate actions, but so far it's imperfect, as we just seen. There is another way. It could be to rely on proxy advisors, because as you know, many investors do not perform their own proprietary research to know how to vote in AGMs, and they tend to rely on recommendation by proxy advisors. And the market for proxy advisors is a very concentrated one, with two American actors, that own more than 90% of the total market share. With the first one being ISS and the second one being Glass Lewis. And we know that when they vote in favor or against a resolution, it has a kind of mechanical impact of driving the votes of shareholders in direction of their recommendation. it is supposed to shift votes by 13 percentage points to 30 percentage points. So depending if they vote for or against, it will affect the final score of the vote by 13 to 30 percentage points, so which is massive. And it's even more observable when the asset manager use the voting system of the proxy advisor, because they do not only issue recommendations, they provide a service to vote, to facilitate the vote. So if you use a system, your chance to follow the default recommendation of the proxy advisor is even more enhanced. So it's even more than the shift I used to describe. So at the end, because of such an importance of proxy advisors, we have a lot of researchers having concerns about the potential negative effects of such an importance. First, it could crowd out individual research. If you rely too blindly on the recommendations of proxy advisors, then you are not incentivized to conduct your own research to decide how to vote. So you cease to be an active engager and an active steward for your invested companies. And second, you can become like what is called a robo voter, like you vote completely blindly in favor of the recommendations of the proxy advisors. And as I said, it's already observable for some asset managers that use the voting system of the proxy advisors. And so far, the proxy advisors, they had a very clear pro-management bias. So they voted massively in favor of management resolution and massively against shareholder resolutions. So that could be a solution, but so far it was a problem because they have a massive pro-management bias. But to be fully honest, we have observed, or researchers have observed, a shift of the opinions of proxy advisors more and more in favor of shareholder resolutions in relation with environmental and social topics. So their pro-management bias, it tends to decrease. And it tends to decrease most probably because proxy advisors align their recommendations on their clients' interests and preferences. They run, some of them at least, run yearly surveys to understand the preferences of their clients, if they have strong concerns about the environment or social issues. And then they adapt their recommendation based on the preferences of their actual clients. So to summarize, they influence the votes of asset managers, but asset managers can also influence the recommendations of the proxy advisors. And they can also engage with the proxy advisors to make their, to shift their opinion and their primacy, I would say. Next one, Nicolas, please. And finally, before concluding, we have decent empirical studies showing that the success of engagement will depend on a series of factors that are very useful to know when you consider individual engagement, but also when you consider collective engagement. So for sure, it's the size of the asset under management that is owned by the investor or the coalition. The resources that can be implemented in the engagement process, because an engagement process is very costly. You all know probably the successful campaign of engine number one versus Exxon, and the cost of it was $30 million of US dollars. So if you want to achieve such a success, to get to change 3 seats of the board of Exxon, you need to allocate 30 million. So that's big money. Third, it's better to have direct access to management and board, and we empirical studies tend to show that engagement has a higher chance of success is if it's led by a local investor and not by an international investor. It's better to have clear objectives for your engagement and also clear milestones. To have in mind prepared an escalation policy that will work out as soon as your request is failing. So you can move to the next step all the way to the top of your escalation strategy. And at the top of your escalation strategy, you should be prepared to use your full shareholder authority, including some very confrontational techniques like divesting or putting on an exclusion list or filing shareholder resolution or initiating proxy contest or even more going into litigation, which means going to the courts. So those are some success factors that have been highlighted by research. And finally, Nicola, next one, which is also the final one, we derive out of the research a list of recommendations that pertain to both the way we need to form coalition, investors should follow to form the coalitions, but also to make the coalition function. So regarding the forming of it, what is good is to mix global and local investors. Local investors because they have access to the management, and global because of their size. Include the big four, especially because the big four account for 10 to 20%, as I said before. It's good also to team up with green activist funds, I mean hedge funds, because hedge funds accept to work not behind the scene. So it's pretty complementary. The dialogue is performed by institutional investors, and the most mediatic and confrontational techniques are performed by the hedge funds. And then you have a series of recommendations on how to make the coalition function. A key one is to make members accountable and to organize roles with a multi-tier system so that you have lead engager that will be rewarded in a way or another in case of success, and you have the supporters, the backers. So that everybody knows what it has to do and the rewards will be associated to the position. And I insist on that. Perhaps there are some techniques to be used above the behind-the-scene consensual dialogue. And there are plenty of actions that are, I would say, nuclear buttons to press in case of a failure to getting success in your request. So that's it, 45 minutes. So we have another 15 minutes for Q&A. Thanks.
Thank you, Michael. And we do have questions in the section and the chat. So the first one, would you have any insight on what the effect can be of pass-through voting? And the second one is, will this likely increase the support for ESG resolutions?
Could you tell me more about pass-through voting? What do you mean by pass-through voting?
Yeah, maybe Rick and also Peter, you guys, you can just speak up. Maybe Rick, if you can.
Yeah, it's something that I've wondered. So BlackRock instituted pass-through voting, so their
yes,
ETF.
Yes.
Yeah, that's so. Would you expect that will lead to more support for ENS resolutions or not? Might be too early to tell, but just consider.
Yeah, actually, yeah, I know what you mean now. Sorry, I had a memory failure. So now it's supposed to be there will not be one size fits all voting by the asset managers. So it all depends it all depends on the breakdown of the portfolios of such large asset managers. So if they have a lot of funds invested in ESG funds, most probably that would increase the support for ESG resolutions. But we need to look at details of the portfolio composition of BlackRock, Vanguard, etc. And especially depending on the fraction that is owned by US investors versus European investors. That will strongly impact the way BlackRock votes then, as a consequence. But that's an interesting, by the way, it's an interesting thing to look at. Depending on the breakdown, whether on paper it should lead to an increase or decrease in ESG support. I don't know.
Thank you.
There's another question from Peter. Do you just want to, you can just unmute yourself and
Yeah, sure. Thank you. I'm interested in data on engagement, so I wanted to know how does one estimate the costs of engagement and why, by the way, it is so costly, and if there is public data on engagement costs.
Oh, it's legal, legal cost. Let's say you want to draft a resolution, you need to ask lawyers to draft it in a way that is legally acceptable, and that is a major cost. And then for engine number one, the costs were related to the media campaigns. So I would say media plus legal cost.
Do you know of any databases with these costs?
No,
No.
I'm not aware of any database of engagement cost, but that, and I searched for it at some point, and the only figures I had was for the campaign by engine number one. That was super clear. Otherwise, you get some figures like for drafting an ESG resolution, it's in the range of 100,000 K. It's pretty expensive.
Thank you.
Yeah, maybe that's important to mention that the engine number one campaign is an example, but it's still a black box, mostly how costly engagement is and what is the expense we should expect actually from an asset manager who's applying credible engagement. So you might, think about metrics like percentage of asset under management as a ratio to define what credible engagement should look like in terms of resources used. Yeah, but so far there's not much data about that. Another question.
It's an interesting question you're raising, Nicolas. In the IPAF, we try to assess the credibility of the way different funds action different impact mechanisms. And for engagement, there is, as you mentioned, Nicolas, there is a question on how much they spend on engagements. Do you have any range of values that makes credible engagement for you as a percentage of management fees? According to you, should they allocate, I don't know, 5% of all management fees, 10%, 20, 50, when they are calling themselves engagement funds? When they communicate so much on their engagement, how much should they pay for engagement? Have you any figures in your mind?
There's an interesting paper just shared by Rick. I don't know, Rick, whether you can tell us more about that.
Yeah, the thinking I had is together with the PRI, has done a research project on resourcing stewardship, so stewardship in total. And they came up with a metric on what do you consider resources, right? You need to have a metric that you're going to measure, so seniority of stewardship personnel, etc. And the median came up at 7% that I figured. I've added the link to the research project itself, so that considers the resourcing framework, the calculation, the metric, and then also the survey. It's not the biggest survey, so I think top of my head is about 46 respondents. But it is that's why the research was done, right? To at least have a figure like what.
Good. Like that's a starting point. Good.
Yeah, exactly. That's exactly why it was done. Super.
Thanks. Andreas, you had also a question.
Yes, thanks. I was wondering, as you mentioned, that it's successful or it has impact engagement. I was wondering what kind of ask or investor requests they were looking at, because they can differ quite a lot in terms of how easy they are to be fulfilled. And I was wondering whether there's like a definition they use.
No, qualitative. I guess the researchers studying the success rate of engagement campaigns, they consider a success when the engager was considering he got something. So it's based on qualitative statement by the engaging investor.
Okay, but there's no common thing that it needs to be something meaningful or just disclosure.
No, that's the thing.
Okay.
Oh yeah.
Okay.
Disclosure is much easier to get compared to a costly reform, like you have to change all your processes for sure.
Yeah, exactly. Okay.
And that's a problem we're having. Like so far, according to us, there is too much mix between the request, too much aggregation between of the request, and not enough discrimination across them.
Yeah.
There's also more explanation in the paper itself about the different studies which we reviewed. And it's a very, very important point, actually, Andreas, because actually Rob Bauer et al., they emphasized that in their sample, they also found success in terms of engagement objective, which was addressing, I can't remember, I think CO2 reporting, but also intensity reduction. And they were successful in GHG intensity reduction, but not total GHG reduction. So engagement, so that's also something we received from another researcher that so our findings should not appear and should be perceived as presenting engagement as a silver bullet for sustainability topics, not at all. So it's only, we know from research that we can achieve incremental changes and potentially only for the low-hanging fruits. But when we talk about secondary market investments and we want to talk about any kind of impact, engagement is, according to the research at least, the most effective strategy to achieve something, but not that this will save the world. That's maybe
because as I said, by engagement, by definition, you can only address the problems that are in the hands of, let's say, listed companies, which is only a subset of the problem.
It makes sense. No, but I think it's good to know that this at least works, and then it always depends on what you insert in that existing structure, I guess, and what kind of ask you can smuggle into. And
I would love the engagers to be also very clear about what kind of requests they are having, because you can respond positively to a request with different ways, and some ways are bad, super bad. Like let's say you want to decrease your carbon intensity, you just sell your brown assets to someone else, and it's no change for the planet at all. So it just leads to what we call brown spinning. So it moves from a very scrutinized and regulated public company to a non-scrutinized, non-public, non-regulated private company. What's the upside for the planet? Zero. I can't even think of a downside. So it's not only what kind of request, is how thoughtful the requests are, how precise they are.
So yeah, there are still many question marks, but I think when we look at all the research which exists, we have already actually a lot of information, what we know, what can increase the likelihood that you within in a coalition, in the best case, can increase your impact potential. But where to draw the line, what we would call credible engagement or not, I think this is a very, very key discussion, which has been gone for a while, but now I feel gets more and more intense, especially in the context of the European discussions on the new regulatory agenda. There's a big call for EU stewardship code. But there, the key question will be, what are the minimum requirements? And we are very keen to increase our work on that subject, and we want to contribute to that. So also it's an invitation for anybody in this call. If you're interested on those subjects, please feel free to reach out to us so that we can continue the discussion. Given that we have only 3 minutes.
I want to answer another one, Nicolas.
From Laura?
Yes, this one, exactly.
Is it Laura, is it you, our previous colleague? Or another
Hi,
Laura?
Yes, it's me.
The question you are asking, have we already engaged with coalition coordinators? No, not yet. And what we are saying here on the functioning of existing coalition is only derived from academic research. So that would be next step for us to discuss with different coalition coordinators to see how we can help them to improve the process. But so far, it's only based on research and not based on interactions we are having ourselves with the coalitions.
And maybe, thank you very much, Michael. And maybe the other question regarding the rewards you mentioned for lead investors, because I struggle to think about what kind of rewards.
Yes, that's the thing. How can we make engagement rewarding for investors? I've seen a couple of papers showing that it's like funds that engage actively, they tend to create a brand image of activist asset manager, which is good for attracting inflows of capital. But we need to see if it's enough. And if it's not enough, to think of schemes. I don't know how. I don't know, resources that can be shared within coalition members. And the more you engage, the more you get access, you can tap into the pool of resources. I don't know. But so far, the question remains valid. Like, if you engage very actively, you're not sure to get more benefits than other investors not engaging fully. So far, the free rider issue is not solved at all. So yeah, we have to be creative to think of schemes. Yes.
Right. If there are no other questions, or I mean, giving the time is over also, Michael, then we maybe close that call. So yeah, thank you everyone for attending the webinar. And as I said, please reach out if you want to continue the discussions or if you have further questions.
Thank you. Thank you all.
Thank you,
Bye-bye.
everyone.